Explainer 9, the consumer. Hi, John Rothfield with Derivative Logic. Consumer spending is 70% of US economic activity. The consumer's balance sheet and employment prospects and what follows from these, their spending and savings propensities, drive a lot of the outlook for and risks to the economy. There is no shortage of private sector information on the consumer spend. For example, Johnson Redbook is a pioneer, having monitored and reported weekly retail sales since 1964. Since credit and debit cards have risen to more than 2/3 of consumer transactions, companies in the card business have taken to publishing timely monthly reports from their proprietary data. Examples of this include the MasterCard Economics Institute. Visa has its own spending momentum index that's published monthly, and the Bank of America's Consumer Checkpoint release. These sources have the ability also to disaggregate into cohorts, including by income, gender, and race. Then, of course, there are government reports. Here we will look at two of those. The first is the monthly retail trade report produced by the Census Bureau. An advanced report sampling about 4,800 firms by phone and internet is released about 10 days after a month ends. The final report, 1 month later, samples about 13,000 businesses. Since this is a survey of businesses, there is no direct way to interpolate who is doing the spending. However, the Federal Reserve has started to use a panel of 150,000 representative US households from a micro data set collected by Numerator, a consumer data company. This data has a 0.84 correlation with monthly percent changes in the retail trade data. Combining the two, the Fed has constructed a measure of average retail spending for low, middle, and high income households. They also show how the heterogeneity in spending by education, generation, and housing status. The retail trade control group is a subset of the total that excludes volatile categories, including autos, gasoline, building materials, and food services. That provides a cleaner, more stable measure of underlying spending trends at retailers and is an input into the national accounts estimate for total consumer spending. A more comprehensive report, rather than the retail trade report, it comes from the Bureau of Economic Analysis. It's called Personal Income and Outlays. That's usually released on the last Friday of the month following the data collection. The data is reported in both volume and value terms, thus deriving an estimate for price changes in each of the categories of personal spending. The personal income side comprises employee compensation, contributions to Social Security and Medicare made by employers. Also, things like proprietors' income, rent, interest and dividends are included in personal income. Then there's a subtraction made from taxes paid into an aggregate called personal disposable income. The residual between disposable income and spending represents the additions to the savings pool. From this data, we could quantify, for example, how much the personal savings pool surged in the aftermath of the 3 economic impact payments made during COVID and the gradual depletion of excess savings over the next few years. This report on personal income and spending has 2 indicators that are not in the headlines but useful for economists. The first is real personal income less transfers, and this is one of the indicators used by the National Bureau of Economic Research to signal an imminent recession if that number is slowing down too quickly. Another is real personal income, disposable version of that income per capita. Real disposable income per capita is a proxy for affordability. Finally, what about surveys of consumers? There are 2 high-profile consumer sentiment surveys, one by the University of Michigan, the other by the Conference Board. The Conference Board Index focuses more on labour market conditions and job security. The key output from that survey is respondents' answers on whether jobs are plentiful or hard to get, now and in 6 months' time. It uses a sample of about 3,000 respondents, both by phone and online. The University of Michigan survey looks at a much smaller number, about 500 households, and focuses on finances and purchasing power. One element of this questionnaire is on whether it's a good time to buy things like houses and cars, for example. The University of Michigan report has, since the pandemic, however, reported consumer spending or consumer sentiment by political persuasion. Here we get an idea that survey responses have become less connected with jobs and finances and more with politics. The sentiment of blue and red respondents flips violently when elections produce a change in government. It is for this reason, amongst others, that back in the day consumer satisfaction correlated pretty well with economic indicators, but now they are a better indicator of who will win the next election. To sum up, the government's reports on retail trade and personal income and outlays provide useful insights into consumer spending, and the latter is a direct input into the quarterly gross domestic product report. As to the sentiment surveys, not so much. But sentiment can be meaningful when at significant standard deviations from its averages. One example is in 2025, where, for example, the gap between sentiment and indicators like job and inflation reached an all-time negative wide. Similarly, answers on affordability questions, whether it's a good time to buy houses, cars, and other durables, fell to all-time lows. It's hard to suggest that these extremes mean nothing. Please let us know if you have topics that we should cover in our Explainer series.